Why do you think the market has continued to do this despite the fact that we have 12 million open jobs? Okay, we have about 11 million people not in the workforce. We have inflation at 6%. We have a supply chain that are getting crushed. We have energy shortages. If the world is falling apart, yet equities just continue up, why is that? Equities are going through the roof everywhere. Economies are all over the place. People are leaving the job force. We're in such a fucked up position. The separation between reality and equities right now is insane. It's absolutely insane. And that's fine. Everybody's like, well, Stocky, if you think it's so bad, why don't you short the market? I ain't shorting the market. There's nowhere else for people to put their money right now. And you know what? If the market crashes, it'll just go back up again and I'll just buy more. I'm not going to try and time this shit. There's nowhere else for people to put money right now. Where do you put money? Let me ask you a question. All right, here you go. For those of you guys who keep saying to me, Stocky, should I short the market? Should I empty out my brokerage account? Should I clear out my 401k? Let me ask you a question. I'm not telling you what to do, but I want you to think about something. All right, you have money. You have your 401k, you have your IRA, you have money, let's say you have, I don't know, $100,000. I know, I'm just throwing money out there because I want to use this number to break down more. It's sitting there doing nothing. You have an emergency fund, you have investments, you have property, you have everything. What do you do with that $100,000? Well, you could keep it in your bank account, okay, earning 0.0000001% interest, so 10 cents a month. Banks aren't going to raise, they keep lowering their interest rate. You can't even get an Ally account with over 1% anymore because they don't need to have high interest rates. They don't need your money. They get 0% loans from the Fed right now. They don't need your money. That's great, but inflation is sitting between 4 and 6%. Let's call it 5%. That means at the end of this year, you'll have $100,000, but you'll have $95,000 in purchasing power. And that's low end. That's low end. Depending on what you're actually going to be buying, it could be higher than that. So you're guaranteed to lose money leaving it in your bank account. Okay. So we'll take bank account out of the equation. You could put it in real estate because interest rates are still relatively low right now and housing seems to be kind of plateauing. But the problem with putting in real estate is if you didn't do it last year, you're basically buying the top. I don't know that, but we've seen that housing prices have done this. And we just saw that Zillow, who was planning on buying up all these houses, we knew they were going to do this last year. We were talking about it. We did YouTube videos on it and everything. We knew Zillow was going to do this. But Zillow was using an algorithm to buy houses overpriced because they were expecting to flip them. But now they're cutting their losses. They're cutting all of their properties. They're cutting about $7.8 billion in real estate purchases that they've made for probably around a $550 million loss. Okay? That's EROB level L's. Okay? $550 million loss. Why the hell would a company as big as Zillow, why the hell would a company that big eat a $550 million loss? If they thought that this was, if they didn't think that they were going to continue to lose more money, or they thought that the housing market was going to dip and then go back up or sustain, they would hate it. They would hold on to it or buy the dip or ride the wave. But they're not. They're dumping it. Now, they say it's because the algorithms, it's too unpredictable, too volatile. If that was the case, bitch, you would keep buying. You would just stop buying for now. Gang. And then if the market continues to go up, sell what you have on the books for a profit. And if it dips, take the cash and buy the dip. You're getting out of the market. So you're expecting something. Your algorithms are telling you something. So if this is the case that this is the top for real estate, you don't want to park your $100,000 in real estate right now. I mean, you might because interest rates are low, and even if the housing prices go down, you're still getting, low interest rates. But the idea is, if the interest rates go up and housing comes down, how far does it come down, and is there a trade-off there? So you don't want to go in real estate right now. So what do we have then? Well, you can put your money in bonds. Bonds are trash right now. I mean, you're getting like 1 to 3% on long-dated bonds. Fuck, you can get a CD for that. You can put it in Ally and get half that. Okay, if this was 1980 and you were getting 17%, fuck yeah, give me that. I would take the hell out of 17%. 17% guaranteed annual return, and you get your total amount at the end of 30 years. I'd buy my daughter 30-year bonds right now, or 20-year bonds right now. Easy money. But bonds are trash right now. Bonds are trash right now. So money's not going in there. All right, we're running out of stuff. We have commodities. Energy, oil, still going up. But it's so fucking high right now. Is it going to be sustainable for the next, couple years? Remember, you're not trading these things. You're looking at a place to park your money. Right? You could do commodities. I mean, oil, they're saying it might go to $100 a barrel. I don't know. Natural gas is skyrocketing, but, if Russia opens up its pipeline, we could see a flood there. If the supply chain gets back in, commodity prices are going to drop. So that's really risky right now because you're reliant on outside forces. Okay, put it in gold. Might actually pay out, but gold's been stagnant for a while. Even with inflation going up, gold hasn't increased because people aren't using gold as a hedge anymore. Because there's alternatives now that there didn't used to be. So there goes gold. You've got crypto, which is actually pretty decent. It's become the new hedge to inflation. But if tapering starts, that could drive a few people to not get into a hedge because the idea is inflation would start coming down. Also, you never know when the U.S. is going to come out with some kind of new regulation, right? You've got Janet Yellen and the Treasury Secretary, Treasury Secretary and the SEC chair both have a hard-on for regulating and cutting down crypto. So you never know the volatility there. Younger people will do crypto, but large hedge funds and large boomers and money that isn't ready to go into crypto quite yet. Because there's so much volatility and so much no regulation, right? So there's a lot there that is also a little bit concerning. So where does that put your money right now? Equities. Why do you think the market has continued to do this despite the fact that we have 12 million open jobs, okay? We have about 11 million people not in the workforce. We have inflation at 6%. We have a supply chain that is crushing it, or getting crushed. We have energy shortages. Okay, I could go on and on and on. Businesses are shutting down. So if the world is falling apart, yet equities just continue up, why is that? Because money is cheap and free right now, has been. There might be some tapering, meaning that there won't be as much money. And if rates go back up, then it's going to be more expensive and you're going to see less people borrowing. But the people who have money have nowhere else to put it. So even if we dip 5 or 10%, we'll probably buy back up until the rest of shit gets together. Now, if you see the market go down and you see everything going down, that's people liquidating, then you've got a big problem. But until then, I'm not going to try and time this market. What I will do is every time I have a winning trade, I'll take a portion of that money that I would normally reinvest into something else and leave it on the sideline for cash and just kind of build up some equity, some cash on the sideline without risking any of my initial investment plus the rolls that I do in case there is a dip so I can buy more. But other than that, that's what I'm going to do. I can't see where else I'm going to go. I'm investing in blockchain and crypto mining because I expect that if inflation continues and we see crypto continue, or people are parking their money, if they're not parking it in equities, they park it in crypto. So I'm playing both crypto as a hedge against inflation and equities. But more importantly, what I've been doing is adding to my dividend positions. Why am I adding to dividend positions?
I invest in Squid Coin.
Why is Stocky deciding to add more and more to his dividend positions all through Q2, Q3, and now Q4? Because even if the equity goes down or flatlines, I'm still getting that compounding interest from the dividend. And where do a lot of people park their money especially in equities when there's volatility? What happens when there's volatility and the Qs start falling? What happens when tech starts falling? What are the stocks that tend to stay green or stay flat? Your strong, stable companies that provide a good dividend. I'm not going all in on dividends, but I am adding to my dividend positions. People thinking that these times buying bonds for yields is a real play. You buy for the increase in value. You bet the yields go lower. Yields on S&P 500, no one buys it for the yield. No, I agree, but no one's putting it in there. Because here's the thing. 30 years, the 30-year yields are continuing to go down. Yeah, it's cheaper now. But the idea is that if there's an inversion there, then we're expecting economic growth to continue to slow, and then they're not going to see a significant increase in bond rates over time. Sure, maybe it increases over time, but is it going to increase to a level that's going to outpace equities in any way in 30 years? Absolutely fucking not, dude. There's no way bonds will go up in the double digits again unless some crazy shit happens. Yeah, you can get in now at 0.5 and maybe the yield goes up to 4 down the line, sure, that's a nice return, but it's never going to see, unless some crazy economic shit happens, and we're never going to see double-digit bond returns on yields. And so why put it in there? If the market is going to average 7 to 10% per year every year, if you take good and bad years, and actually as much as 10 to 15% a year over the past 10 years, you're not going to get bonds to outweigh that. Yeah, sure, there's less risk, but you're not going to get into double digits. I'm not against having bonds. If you want safety and security in your portfolio, fucking yeah, go for bonds. But it's not like it was in the past. We're not going to see that. You know what I mean? Now, if you're going to do bonds, get corporate bonds. If you have a way of getting corporate bonds, that's the 5-head play. Because corporate bonds will pay you more because there's more risk. But if it's a good company, you're probably going to be okay. I've seen Amazon do some. Verizon just did $300 million in corporate bonds, and they've got a huge growth potential. Yeah, that's the 5-head play. If you're going to do it, I mean, you could do municipal. Maybe they're a little bit higher because there's a little bit more risk, but you're not worried about a city going bankrupt. But corporate bonds are the way. Now, not everybody has access to corporate bonds, but corporate bonds are the way. If you can get a good blue chip company that's doing an offering through corporate bonds, that's the play right there. I know, never say never. Who knows? Maybe the entire world goes to shit and we have 20% return on bonds down the road. I don't know what's going to happen. What do you say to people that claim the president is solely responsible for macroeconomics changes and trends? Those people are stupid. A president can have effects, but because here's the thing. Let me tell you something about markets. We don't care. Investors don't care about a lot, like significant about who's president right now, because the president's going to change in 4 years or 8 years. And if it doesn't, the government's going to flip. Do you know what I care about as an investor? If I'm going to I'm going to step away from stocky and I'm going to be the stock guy for a second. I love when the government's fighting. I love it. You want to know why? Because when the progressives and the moderates and the Democrat Party are fighting each other and the Republicans are being assholes, or the Republicans are in charge and the Libertarian Freedom Caucus is fighting with the moderates and the Democrats are like saying, fuck it, let them fight. Do you know what that means? Do you know what that means? That means nothing happens. That means no new regulations. That means no new taxes, no new corporate shut down. It means no more laws passed to help the environment. So you know what that means? Corporations run wild. They buy back shares. They do offerings. They give golden parachutes to their CEOs, meaning that they drive up even more. CEOs are now inclined to raise the stock prices so they get a bonus, meaning that as a shareholder, I make more money. Okay? I'm a retail trader. That's not how I think. Inaction is the greatest thing for a corporation when it comes to governmental policies.